uh, lunch event today. My name is Moez Souissi. I'm the Deputy Director of the IMF Middle East Center for Economics and Finance, known as the IMF-CEF. And as you all know, the IMF-CEF is the IMF's regional training center for learning, dialogue, and research, serving the 22 Arab League countries. And we are happy now to have you with us today. So the IMF-CEF has recently partnered with the Euro-Mediterranean Economists Association on this important initiative, the Joint Research Webinar series, aimed at connecting high-quality research with pressing policy challenges across our regions. We are pleased to launch the series today, providing a structured platform for both emerging and established researchers to present policy-relevant work, receive constructive feedback, and engage in dialogue with policymakers and practitioners. Before I introduce the topic of today's webinar, as well as the speakers, it is my great pleasure to give the floor to Professor Reem Ayadi, Director of the Euro-Mediterranean Economists Association, to say a few words about this collaboration. Reem, the floor is yours.
Good afternoon to all. Thank you, Moaz and Zouheir, and of course, Sami, for this great partnership that we are starting with the launch of this joint research seminars. So, as you mentioned, Euro-Mediterranean Economists Association and also its research network, the Euro-Mediterranean and African Network for Economic Studies, are very happy to partner with you within this important launch. I am the president and founder of the Euro-Mediterranean Economists Association and the director of the Euro-Mediterranean and African Network for Economic Studies. So let me just say a few words. First of all, I would like to welcome all the participants today. I see a great, very strong participation across the Middle East, also the Mediterranean, and we would like even to go beyond from different partners, not only from policymaking, but also researchers, academics, and practitioners, and eventually also central bankers to work with us. So it's important to recognize that this collaboration is very timely. It's also based on rigorous research, and also particularly policy relevant and innovative. So this is extremely important for us to continue this collaboration and to start it and continue it, and to ensure that we are really solving pressing societal needs with economic policy, great solutions, but then embedded and anchored in innovative scientific research. So really, this is cross-cutting research that could be very useful for us to have or to solve our real policy needs. And nowadays, those policy needs are really quick, particularly in an era of artificial intelligence, and where we go faster than we used to go before. So, in fact, this research webinars are really to translate innovative research into policy-relevant solutions for our regions. Our regions, in fact, are navigating a very important period of transformation, marked by economic rebalancing, demographic pressures, climate risks, digital accelerations, and also geopolitical uncertainty. So at the same time, we need to take decisions, as I mentioned, faster, sometimes with imperfect or delayed information. And this is why, in my view, we need to step up this collaboration, trying to really to embed and disseminate high quality, innovative policy research into really strengthening this interconnection between researchers and policymakers, and also to support the capacity development and cross-regional learning within our space and region. So really, I mean, I encourage you all to connect with us, and also to send your papers. I mean, of course, we are launching a call for papers. Today, the first paper that we're going to listen to, it's about Nowcasting GCC GDP, a machine learning solution for enhanced non-oil GDP real-time prediction. And this is really a very interesting and innovative research that we will learn about in a few seconds. So clearly, for me, it's a pleasure. It's an honor to collaborate with you. Of course, as I mentioned, there will be a call for papers, and our series of webinars will happen every month so you are aware of it. And I would like finally to conclude by thanking the colleagues. I mentioned Zouheir and Sami Ben Nasser, of course, and Moez Souissi, for this work together, and all the teams of Euro-Mediterranean Economists Association and then MNS. And I would like now to give back the floor to Moez. Thank you very much.
Yeah, thank you very much, Reem, for these kind words. So let me say a few words about the topic today. As Reem mentioned, today's webinar will feature a recent IMF working paper. The title is Nowcasting GCC GDP, a machine learning solution for enhanced non-oil GDP real-time predictions. And our speakers today, Ms. Monica and Ms. Greta, will introduce a new machine learning-based nowcasting framework to generate real-time estimates of quarterly non-oil GDP growth in the GCC countries. Let me say a few words about the presenters. So Monica is an economist on the IMF Saudi Arabia team, and she works at the Middle East and Central Asia Department. Previously, she worked in the IMF's Monetary and Capital Market Department, where she delivered several technical assistance missions on central banks operations and liquidity management. Her publications cover topics including macroprudential policy, nowcast, digitalization, productivity, and she holds a PhD in economics from the University of Washington. Ms. Greta is a research officer in the IMF's Western Hemisphere Department. She works at the front office. She previously worked in the IMF's Middle East and Central Asia Department, where she worked on the GCC countries. She also worked in the IMF's African Department. Before joining the fund, Greta worked at the World Bank, UNDP, and UNFPA. She holds a master's degree from Columbia University School of International and Public Affairs and a Bachelor of Science in Applied Mathematics from the Florida Institute of Technology. Finally, I would like to express our special thanks to the government of Kuwait and to the Kuwait Investment Authority, who host and sponsor the center fully. Let me now give the floor to Zouheir. He is our senior economist from IMF-CEF and who will be moderating the event today. Zouheir, the floor is yours.
Thank you, Moez. Thanks, Reem. Thank you very much for the introduction. Yes, my name is El-Sahli. I'll be moderating the session today. So let me just go through some housekeeping items before I give the floor to our speakers. So before we start, let me remind you of our call for papers that you see on your screen. If you're interested in presenting during this webinar series, please email us your abstract and paper to the email addresses shown on the screen. Also, if you'd like to be added to our mailing list, please enter your name and email address in the pop-up on your screen that you should be seeing on your screen now. During the presentation, we'll be taking your questions in writing only, so please use the Q&A icon at the bottom of the screen to type your questions. Please mention your name and institution with the question. The questions will be handled after the presentations, after the 45 minutes allocated to our presenters. So we'll be waiting for your questions eagerly. Thank you very much for your patience. I'll give the floor now to our speakers. I think Monica will be going first.
Thanks a lot, Zouheir. Can someone show your screen? Then I will show my.
Yes, I unshared now, so you can share as yours now. Yes, thank you.
Okay. Okay, I think it shows good on my side. Let me just adjust a little bit. Okay. I think all of you can see it well, right?
Yes, we can see it.
Okay. All right. Good afternoon, everyone. Thank you all very much for being here. And up front, I want to thank for the great opening remarks and the introduction of our colleagues. So today, I'm really excited to be here to present this joint work with my colleague Greta Polo, focusing on nowcasting the GCC non-oil GDP. And our paper introduced a machine learning-based framework for the real-time quarterly prediction across the 6 countries. And what I would like to highlight upfront is that our emphasis is really on the near-term policy surveillance rather than the medium-term projection. So before I dive in, if you'd like to explore our full paper, please feel free to scan the QR code here, which will take you to more details. Okay, so here is the outline we have for today. We will start by answering why our work matters and what are the innovations we are bringing to the table. We set the big picture with the framework and the data. Then my colleague Greta will guide you through on the technical side. For example, how does the machine learning work, and what are our key findings and the country insights, as well as how robust our results are. At the end, we will tie together with the policy implications. First, let's look into the most important questions. Why nowcasting matters so much in the GCC region? The first and the foremost, because the national account data publication always comes with a lag. As we see in the chart on the right-hand side, Saudi Arabia is among the most timely GDP reporter globally, published its first official estimate 68 days after the quarter end. Meantime, most of the GCC countries, like half of the GCC countries, including Bahrain, Kuwait, and Qatar, report around 90 days. And Oman is around 105 days. They are kind of around the benchmark that we are looking at, the median line of the 90 days, which captures the median of most large EM as well as some of the advanced economy. On the other hand, we see the UAE lags a little bit further due to its different emirates, because there are data compilation at the different emirates level, and it takes some time to construct the federal aggregation for the national GDP. Okay, so saying that, even think about that in a fast-moving environment. Think about in the 2025, when there was a lot of a global uncertainty that Rim also touched upon in her opening remark. Even the 3 months publication lag sometimes will still not be that timely. Why? This is also due to the fact that the policy making also takes some time to design a policy until the time the policy actually implemented. That can take at least a few months and sometimes can take years. So as for now, we see the GCC countries diversify beyond the oil. It is important for the GCC policymakers to really have the real-time GDP data to be able to act proactively rather than reactively. Why is that? Because the real-time GDP data would allow them to support the growth early and access to the reform across the region as it unfolds, and respond to shocks before they materialize or become more persistent. The last 2 points here, beyond the timing, we see that the oil volatility, they can mask the underlying domestic momentum, and the rapid structural reform can also create a fast-moving dynamics that sometimes the traditional models are struggle to capture. Think about the recent lessons that we can draw. As of now, markets and a lot of policymakers are expected the oil price to be lower in the near term. In that case, what would be the appropriate fiscal policy response? The short answer is that it really depends. but I can give you some example. If it is the case, as in some of the GCC countries, in face of the low oil price scenario, but the domestic demand remains strong, shows in a lot of in the estimates, a desirable fiscal policy would be to avoid pro-cyclical tightening, meaning that if the domestic economy can still carry the growth, aggressively cutting down the fiscal spending would not be a good idea, and sometimes it may even hurt the diversification efforts in the GCC region. So what we are trying to say here is that we are not trying to replace the official GDP release, but to really fill the critical information gap between those releases, which will empower the policymakers in the GCC in the critical moment, especially during either the shocks or the reform episodes. The second question I would like to focus here is that why do we focus on the non-oil GDP instead of the overall GDP? Some of the points here on this slide I already touched upon earlier, but let me emphasize the key messages. We do acknowledge that there are fiscal spillover and the interlinkages between the oil and the non-oil sector, because even as the reform progress in the GCC region, we still see the oil economy in many GCC countries takes a large portion of the total economy. And through either the fiscal channel of the oil revenue or the liquidity in the financial system. So the non-oil GDP is really the ultimate, more polished, relevant indicator for guiding the policy decisions because they are better proxy for the domestic demand. In the right-hand side chart, we see that as we in the GCC countries hit pretty badly by COVID-19 crisis, but the non-oil sector really rebounded quickly and achieved the growth that's even higher than the pre-pandemic level. Think about in the 2025, when there is a large global uncertainty and the trade tension and the lower oil environment, we still see all the GCC countries showing pretty resilient growth. And our model comes in around the time of the 21, that was initially when we started the work. And our model really tracked the downside of the COVID period pretty well, and also the recent pick up of the non-oil growth surge in the GCC countries. And that kind of information really helps us to gauge when to act and enhance our policy advice to our member countries. Next, let me give you a little bit more idea of the two ways we rely to project non-oil GDP growth in our GCC division of the IMF. So first, let's turn into the purple circle. Same as other IMF countries, the macro framework remains the cornerstone for our desk projection because it covers medium-term projection of a 5-year out, which is a tool based on the theory-based structural model, and that specifically accounting for the interlinkages across the real sector, fiscal sector, external sector, as well as the monetary. So therefore, the macro framework produced the policy consistent projections. On the other hand, the Nowcast tool we're presenting today, it focuses more on the near-term growth, specifically the current quarter, by leveraging the high-frequency data and acting as an early warning for the economic region shifting. As I mentioned earlier, particularly we have a strong performance at the turning point when we see either there is a shock or there is a large reform that introduced a structural break. So together, what we see is that the Nowcast really complement our macro framework through more enhanced economic surveillance between our Article 4 cycles, support cross-country comparison, most importantly, strengthen the risk assessment in our projection. And we do visit every other month to see how our result update and to see if our 1 year out or 2 year out forecast needs to be revised accordingly. Next. I'm really excited to present to you this slides that really that highlight the key contributions of our paper. So comparing to the existing literature, when their meanings are focused on using the conventional parametric models, for instance, the dynamic factor model, the Bridges model, our paper comes in to focus on the non-parametric machine learning approach, which gives you more flexibility and adaptability. So why there is a growing use of a machine learning in advanced economy to nowcast the GDP, we rarely see it happens for the GCC countries or MENA countries up until now that you see our paper. Also, instead of a focus on the single country or utilizing the single model approach, our framework built the first GCC-wide nowcasting framework that testing the 22 models side by side, which allows a systematic comparison. Most importantly, we also tackle the classical critique of the machine learning being a black box. We use the Shapley value for transparent interpretation, which gives us insights into the drivers behind our nowcasting result. If I were to summarize these slides or the features of our tool in 3 words, I would want you to take away 3 words: flexible, comprehensive, and transparency. Okay, after talk about all of our innovation, I think you must be curious what is our nowcasting model's performance. Then let's pick up the result here of the Saudi Arabia as example. So as you see in the chart here, comparing our nowcast result, which is represented by the red triangle here, versus the official flash estimates produced by the Saudi Arabia GStats. This is the black dots, which published 30 days after the end quarter. We see that both of them kind of roughly follows the trend of the first official publication, the blue line, which became available after 68 days. That was the GDP publication timeless I was showing earlier. In terms of by comparing the average forecast error, sometimes depending on the sample period that we are looking at, sometimes our nowcast model outperformed official estimates, sometimes the flash estimates outperform, but both our nowcast have the average of forecasting error less than 0.15%, so which is pretty accurate. If we turn into the red dots in more recent period in 2025, we do notice that there's a slight overestimation in 25, but if we compare, but as the Q1 and the Q2 data of the GDP non-oil GDP has been revised upwardly by GStats due to the methodology enhancement of the rebasing to 2023, we see that the blue lines moves to around 5.5 for Q1 and 5.6 for Q2. That aligns more closely with our nowcast. So what does it tell us? There can be 2 reasons behind that. The first one is that our model does have the real-time value by capturing the trend early. And the second, it may be the case that okay, because the set of the variable that we used for our Q2 and the Q3 result, which were not covered in the paper, was still based on the GDP, historical GDP before the rebasing methodology was used for the revision. So it will also prompt us to further refine our variables. So maybe there is a need, we need to revisit our set of variable by running more to further looking at perhaps the new sets of variable that will give us the better result. But Greta, my colleague Greta will tell you more about it, how we run the process later. Before that, let me walk you through the 4 building blocks here in our framework. First, we begin with a large pool of the high frequency indicator. Then we apply a rigorous process of the variable filtering to select a finite set of the inputs to feed it into our machine learning model. And lastly, we interpret the result with the Shapley value As I mentioned earlier, its Shipley value is important for us to tackle the critics of the the black box critic of the machine learning. And the Shipley value we use is not just a synode, it actually actively guides us in refining the model. So it's an iteration process. It's not, the whole framework is not done in one shot. We have been going through an ongoing validation to ensure that indicators are more consistently contributed to our result. And that is also why for Saudi Arabia and the UAE, we tend to have a better fit compared to the rest of the GCC countries, because we had more time to really test and refine across multiple sectors as we started with those two countries first. Turning into the first stage of the nowcasting framework, try to show you more of the intuition. We grouped the high frequency data into 4 groups. So the first 2 groups, the domestic activities as well as the manufacturing and the sentiment, they are the usual indicator that you can see in literature related with the directly or indirectly related with the GDP. And the last 2 categories here, they more characterized the regional characteristics of the GCC countries' non-oil GDP. So given the GCC countries' prominent oil exporting role, we still see there is the significant linkage between the oil price and the oil quantity exporting with the non-oil GDP growth. And maybe the extent, the linkage is stronger in Saudi Arabia versus other countries like Bahrain that has less the oil exporting. But due to the oil's linkage and oil sector, we also see that the region is significantly influenced by both the regional and the global spillover. And that's why we're also looking at the trading partner performance in terms of the real growth, the stock market growth, as well as the trade patterns. On top of that, because the GCC countries are pegged to the dollar, the currency are pegged to the dollars, so the policy rates are moving in line with the change of the federal fund rate. And this also means the global spillover, global financial condition also matters for the domestic financial monetary policy and the liquidity condition, which also has the spillover effect to other part of the non-oil economy. In the next stage, our variable filtering stage, the message I want to highlight here, what matters is not more data. Sometimes when you have too many choice of data, bringing a lot of noises, you may have an overfitting issue or have the noises that will hurt the accuracy of your modeling, your nowcast result. What really matters here is to have the right data, which means the data needs to be timely, stable, and consistently informative. To be able to ensure that, we first started with millions of series available online in the CEIC and Haber database. We first consider the variables that with reporting lag less than 45 days after the reference date, and with the minimum coverage of the 10 years. After that, we narrow down to around 1,000 indicators. Then we put them into data around the correlation screening by excluding indicators that tend to have a low correlation with the historical non-oil GDP. So here we look at the benchmark of a positive and a negative 0.7 correlation coefficient. After that, we got around the 50 highest correlated series, then fit them into the horse race run for each country, also with the permutation. This list us ended up with around the 10 to 15 key indicators per country. So a lot of criteria here that we use here can be modified, tailored to your country-specific case, but the choice we have is also consistent with the previous study together with our robustness check that indicates that the nowcasting model typically incorporating around the 10 to 15 indicator spanning at least 10 years would tend to have the best performance in terms of both of the accuracy as well as the generalizability of the nowcasting framework. One more thing I want to highlight is that for the as the new data becomes available, our automatic framework would also allow us to incorporate the newly available data in the updating framework. So it's always in an ongoing process. Next, turn into the machine learning phase. Once we select the data, we run the full hyperparameter tuning process. We compare around the 20 to 30 models, depending on the countries, including the 22 machine learning nowcasting model that I mentioned earlier, and some basic ones like OLS as a comparison benchmark. Then we select the best model based on their predictive top power. In the baseline, we look at the out-sample root mean square of error. Greta will give you more explanation later. Then eventually we produce our results. Okay, now I will pass it to my colleague Greta, who will dive into the technical side and also give you more of the country-specific findings. Greta, please feel free to share your screen.
Thank you so much, Monica. Are you guys able to see the screen now?
Yes, very well.
Thank you so much. Okay, so Monica really gave a fantastic overview of the entire process, which, as you saw, was actually very involved. What I want to talk about here is a little bit more on the nitty-gritty, the actual variables, some of the results, really give you something that's maybe a little bit more tangible that you can see here. So the first thing I wanted to highlight is maybe let's look at some of the input variables, specifically for Bahrain in this case. And the beauty of the work that we did is that we really have the ability to compare across the different GCC countries. So that's something that you can also look at on your own time, how different things compare and contrast. So you can see here that in the Bahrain model, we really see an emphasis on domestic consumption. And this is also kind of visible because of the service-oriented economy. Hence, some indicators you can see here, like point of sale transactions and CPI and so on. And this is important, and I want to highlight this because this is something that's not as central in some of the other GCC models, right? So this really reflects the more service-oriented economy that we're seeing on the Bahrain side. In other GCC countries, you'll see that retail indicators or card data are not consistently available or used, and so they're often excluded or maybe used with a lag. So why does this matter? Bahrain's consumption-led growth models kind of make these variables like point of sale particularly relevant. In other GCC countries, maybe like Saudi Arabia or UAE, which we'll also look at, investment or government spending is a little bit more of a dominating factor there. We also see, that the Bahrain model includes some of those M2 deposit rates, financial market indicators that really kind of reflect some of those liquidity conditions that are really essential there. And this is important because obviously we see that the Bahrain's private sector is a little bit more sensitive to these financing conditions. So money supply and rates play a bigger role in driving some of that short-term dynamic there. So how does that compare to the other GCC peers? Overall here, we're looking at Bahrain being a little bit more consumption focused, and it reflects maybe a more open and service-oriented economy. And really just to highlight that this approach is a little bit different from maybe your standard approach because we're trying to capture those different dimensions that Monica also mentioned. So we're trying to look at those global demand signals. We're trying to look at some of those short-term indicators that in the case of Bahrain might be liquidity and public debt. We're trying to capture that domestic consumption side, and we're also seeing some of those more detailed price dynamics be reflected here. So how does this compare and contrast, to Saudi Arabia and UAE, right? So here we're trying to see how our indicators differ across different countries and how they actually reflect the underlying economic structure rather than some of the modeling choices. Now, as Monica described, the way that we are actually selecting our indicators is through this mathematical process, right? So we're not cherry picking our indicators. So what we like to see actually is that the differences between each of the countries and each of the indicators that are selected really reflects the economic structure, right? So if we start with Saudi Arabia here, we can see that the indicator set places relatively more weight on domestic real activity and policy relevant supply side signals. So we see some indicators such as cement deliveries or non-oil exports, also that crude oil production, which really kind of captures that construction activity side, some of that industrial momentum, and some of those fiscal spillovers. We also see that financial market depth also shows up very clearly. So we see those stock market transactions, those volumes, the Tarwul index, really kind of in reflecting some of that investor sentiment and again bringing in those liquidity conditions. So this again reflects Saudi Arabia's scale. It has that investment length growth model, and there's a strong link that we see between fiscal activity, construction, and non-oil output. So it's again good for us to see that that is reflected in the indicators that are selected here. By contrast, you can see on the UAE side that this set is a little bit more externally oriented, right? So we see that international cargo and passenger traffic, we're looking at different PMIs, we're looking at in that industrial production indicator from major trading partners like the UK. So this reflects the UAE's role as maybe more of a regional global hub when you think about trade and logistics and tourism, and external demand playing a much larger role in driving some of that short-term non-oil activity, right? We also see some of that financial volatility indicators like the VIX that also matter a little bit more here, that help us capture more of that global risk sentiment that feeds a little bit more quickly into the UAE economy. So our style of work is not necessarily imposing a common structure across country. Instead, like I mentioned, we're mathematically deducing all of these indicators that then reflect the realities on the ground. So this is exactly what we would expect given all of these different economic structures. And it's really a good example of how our framework also then adapts kind of naturally to some of these country-specific realities. Now, let's go a little bit into the data set partitioning here. So this is to kind of give you a sense of how we're training and we're testing the data and what exactly we're doing here. So when we're originally trying to do everything, we're training our data on 85% of our historical sample. So if we have, for example, 10 years of data, 85% was training on the historical data, and then we're testing it on 15% of the holdout sample, but still of actual data that we have, right? So this ensures that our model selection is driven by a genuine out of sample performance that then would allow us to estimate the entire period to give us that extra quarter or two. So here I really want to emphasize that we really have what we think is a rigorous model training kind of temporal integrity side here, because having this train test split really ensures that our models learn from the past period and are validated on unforeseen future observations. So this tries to avoid any sort of forward-looking bias and tries to mirror how the model will perform in real time. When we are actually estimating our quarter, so we're doing that nowcast, say for Q4 of 2025 or Q1 of 2025, we are relying on the available data that is available on the high frequency side, right? So we're not trying to predict months and months ahead. If we have data until, say, December of 2025, that allows us to have a really good estimate of Q4 of 2025, because this allows us to essentially fill the lag gap with our current data. So we're trying to make this something that is operationally useful for policymakers to have some more immediate insights, but we're not trying to forecast large periods of time in the future, because then there's too much uncertainty there given how high frequency our models are here, right? So now let's go a little bit into what machine models are actually used. So you might look at this and think, oh my goodness, I have no idea what all of these are. And I'm quickly going to explain what this means and really what you want to take away here. So we're basically using four larger categories of different types of machine learning models. The first one is on that linear and regularized regression. These are maybe ones that you might be a little bit more familiar with. These capture more linear relationships, right? So they have more of a stepwise selection and they really kind of improve some of that generalization. The second component here is the dimension reduction models, and these are trying to reduce kind of predictor dimensionality. It is more commonly, if you think about, principal component regressions, see, these are some of the earlier, more popular machine learning methods. So maybe you've heard of those as well. Then we look into tree-based models, and this one is quite important because it really helps us capture some of those nonlinear interactions through different ensembles, right? So here, think of random forests, which are really popular, or some sort of Mars, which are kind of more flexible splines. And lastly, we have some of those support vector machine models. And these, think of them as, we're trying to fit even more complicated relationships with strong kind of regularization properties. So across all of the GCC countries, we consistently see that those tree-based models, so that third category there, such as random forest and stochastic gradient boosting trees, really deliver a strong out-of-sample performance. So we see that they're really strong performance in the GCC. And the main reason is that these models are really well suited, again, to capture those non-linear relationships and those interactions across indicators, which is very important when we're thinking about short-term macroeconomic dynamics. They also adapt better to some structural changes or any sort of larger regime shifts. So for example, during that COVID period, right, we saw sharp oil price movements without requiring us to specify any of those breaks ex ante. And we see that those models are really capturing that. So in other words, tree-based models are flexible enough for us to learn how the economy behaves differently across states, and it's critical for us in our nowcasting. Just a small caveat here as well. Some of the larger, more diversified economies like Saudi Arabia or UAE, sometimes we do see that some regularized linear models also perform quite competitively because they might have a little bit now a more stable and well-measured relationship. But this is just to give you an overview of what all we're doing. So once we have all of these models, say that we've trained them on that 85%, we've tested them on the 15%, how are we picking the best model? So the best model for us is really selected using that out of sample root mean square error as the primary metric. So the lowest root mean square error would be the best performing model, right? Because that's the lowest error bound for us, indicating that we have the most confidence in this one. Obviously, we're also looking at other statistics that we're producing here, such as the MAE, any sort of bias checks. We also have that rolling window validation to ensure kind of more of a temporal stability and any sort of guards on overfitting. It's also important for us to, have a little bit of a smell check when we're graphing all of our work. Do we see any sort of overfitting? Do we see that it's 100% line by line? Then we have to take a look again and see what's going on, right? Now, one of the things that Monica alluded to before was our use of shapely values. And I want to really bring your attention to this because we're not only using them to identify things as a descriptor at the end, but we're really doing an overall decomposition and iterative process for us to find the best variables using shapely values. So briefly, what exactly is a shapely value and why is this important for us? Shapely values allow us to break down each nowcast into the marginal contribution of each indicator included in the model, right? So think about it as each variable is treated as a player contributing to that final forecast, and the shapely values tell us how much each player actually matters for the team to win the game, right? So we do not use shapely values just as that after the fact diagnostics. We're starting with a broader universe. So when we're trying to find that set of indicators and we're running all of those different permutations that Monica was talking about, we're computing all of those shapely values across the models to identify which one of these indicators is actually consistently contributing to the prediction. And later we're going to show you some of those graphs so you can also visualize, okay, what exactly does that mean and how do I see that? So indicators with persistently low contributions are removed, and then the models are re-estimated on that refined set. And we're also testing the performance again and again once the actual GDP data is actually released. So think about this process repeated so many times for different indicator set coverages until we arrive at a stable group of variables that then adds information without introducing some of that noise that Monica also mentioned there. And that's how we're getting down to those 10 to 15 indicators. Now, the benefits here are, number one, we are data driven, right? So this is not an intuition driven analysis. The economic judgment, of course, guides the candidate pool, but the data decides really what stays in. And then second, this really actually helps us avoid the overfitting, right? So noisy or redundant indicators that could look useful in sample, but they add little to marginal no value are then evaluated through the shapely contributions and then either deleted or kept, right? And then really the end result is kept deliberately to those 10 to 15 indicators because this allows us to be stable over time and also interpretable across different countries, which is essential for some of our work here. So from a policy perspective, this means that when the nowcast moves, we can also explain why it's moving in this direction, whether it's driven by domestic demand or external spillovers, rather than just reporting the actual number itself. And that brings me here to why interpretability actually matters for policy. So interpretability is essential for any sort of credibility. So in our case, these shapely values really allow us to explain any sort of forecast revision and really avoid kind of that black box concern that really comes with machine learning and communicate these results as clearly as we can through our work. Now, let's look a little bit at the results in the big picture, right? So across countries, we can see that our models track non-oil GDP very closely, as well as all of the different turning points, included the COVID-19 shocks. Our models are stable, they have timely signals, and we have a lot of robustness checks, which allows us to see, okay, they're consistently delivering over time. So what's important here is not just the fit, but the timing, right? So the models are most informative precisely when we need the signals around those turning points and the shock, and that's really important. So Monica had briefly touched about some of the results, and I'm just going to bring your attention here to Saudi Arabia. So these are just results that we computed for the purpose of this seminar that are actually beyond the scope of the paper because they're more recent. So we can see here that, our model, in this case for Q4 2025 nowcast, aligns quite closely with the flash estimates overall and kind of reinforces our confidence in that real-time accuracy. Now, let me bring your attention to the shapely decompositions, right? So we had talked a little bit about what these are. Now let's see, okay, what do these actually mean and how do we see them in our indicators? So here, when we say, for example, on the top there, non-oil exports have a positive contribution here, what does that mean? Well, that doesn't mean that non-oil exports simply increased. It just means that given the recent behavior of non-oil exports relative to their historical patterns, our model, in this case, is interpreting this information as supporting a stronger non-oil GDP growth in this quarter. So in simple terms, non-oil exports are sending a signal that aligns with stronger domestic activity, maybe, for example, through manufacturing or logistics, and the model is using that signal to push the growth estimate higher, right? Now, it should be clear that, this is a statistical contribution. It's not necessarily a causal statement. And also, I want to mention a little bit about the bar length and the direction here, right? So the length of each bar reflects that marginal contribution of that variable to the overall nowcast. So the positive bars push the nowcast up, the negative bars pull it lower. And also how the length of the bar, the bigger the bar, the more that marginal contribution is. So what does that mean? That means that if we see, for example, that the Saudi Arabia Consumer Price Index over the course of multiple quarters is not contributing a lot, then we would look at that indicator and say, okay, do we want to keep this indicator? Are there other indicators that, would have a little bit more of a contribution to allow us to have some of that, iterative work on the indicators. Now, just briefly on the negative side, right? So you can see on the downside here, we have some tighter financial conditions, possibly such as higher short-term rates, and that's what's pulling our nowcast down, reflecting kind of that model's interpretation that financial conditions are acting as a headwind to growth. So Monica had briefly mentioned a little bit on how our work has compared with some of the flash estimates in the previous GDP work. And here I would also like to mention that, we have worked very closely with our colleagues at GA-Stat and across different Saudi Arabia ministries on this. So it's really been such a collaborative effort, and we're very, very grateful to them. And we can see that really our comparison across vintages shows that our nowcast really tries to remain robust, even as the official GDP's series are differently revised, really kind of underscoring some of that framework stability. And as Monica mentioned, our staff nowcasts are actually a little bit more in line with that revision more recently. So that's something that's going to be important for us to look at moving forward in terms of different indicators and so on and so forth, because we haven't changed anything. We're just looking to see if our models can actually adapt to the new revised GDP series and what's going to work there, right? Now, let's briefly look at UAE, right? So UAE is a little bit of a different story. UAE doesn't have those flash estimates for us to compare to, but it has a little bit longer of a lag. So the value added of this model is really giving us a heads up on some of those periods that may not necessarily be available straight away. So in this case, you'll see that we have now casted essentially the second half of 2025, Q3 and Q4. And what we're seeing is that signal to be around 5%. So what's going to be interesting for us is to see, okay, when those official statistics come out, how does that compare for us? Now, again, with that shapely decomposition to give you a sense of, okay, what is coming underlying this data, what's driving some of this. So for UAE, we see that that external demand and those global conditions such as international cargo traffic or foreign industry productions are kind of more dominant contributors to that Q4 2025 nowcast. So comparing that to Saudi Arabia, where domestic activity and those internal financial indicators play a larger role, the UAE shapely profile is more outward facing, and again reflecting some of that deeper integration into the global trade and financial cycles. So we can see that external demand and global financial conditions play a larger role in UAE, really reflecting that that integration as we mentioned. So just briefly a little bit on some cross-country differences here. We can see that, Saudi Arabia, UAE, and so on really benefit from that richer domestic data pool, whereas countries like Oman and Kuwait really rely a little bit more on those external indicators. These differences really reflect both the structure and the data availability over here. And one of the things that we mentioned previously here is really some of that operational validation that we saw on the Saudi Arabia side. And we really want to emphasize here that we're not trying to replace any sort of existing process, but really help provide a early complementary signal that can help inform analysis and discussions ahead of any sort of publication, right? So this type of alignment really reinforces combining different high frequency indicators with different statistical system to really have a more comprehensive view, and really to emphasize that what we're trying to see also is the direction of things, right? So if we see that there's an expansion or a contraction happening, are we moving in the same direction as different estimates? And do we all see the same thing in some of those early warning signals? Monica had also mentioned some of the robustness checks that we had done, and really there is quite a lot. We did some on including rolling window validation, alternative loss functions, bottom-up sectoral analysis, and different composite external indices. In the interest of time, I'm going to go relatively quickly and just emphasize some of that bottom-up sectoral analysis that we did specifically for Oman. So essentially what we did here is we separated our nowcast of non-oil GDP into services and tradables GDP and aggregated these closely to total non-oil GDP. And then we created a different nowcast, one for services GDP, one for tradables GDP, and the normal one for total non-oil GDP. And we're looking to see whether our nowcast for those subsets would then essentially add up to be similar to that total. And we did see that that was something that worked out really well for us, which was very important because that way we could also see, okay, those services that drive that short-term volatility, what are some of the indicators there? Whereas the tradables really respond a little bit more to those external shocks. So all this to say, okay, how does this help policymakers, right? So nowcasting really enables a little bit of that earlier detection to any sort of slowdown or large expansion, which allows you to have a better timing of your policy response. And it also gives you that more granular sectoral insight, which can also then lead to a more improved risk assessment. So that's a little bit of the work that we're really trying to emphasize here. And of course, like everything, there are some limitations. And so just to highlight a few for here, we obviously have to be mindful of any sort of data revisions and really go back and revisit things to make sure that we have that. There's also a little bit of that uneven data availability. So in some cases, right, in the Saudi Arabia case, we might have a little bit more data, so then our whole modeling process will be a little bit more robust. And of course, that need for ongoing monitoring really remains critical, because you want to make sure that you're incorporating new indicators and things that are still relevant. And again, really to emphasize that our framework is statistical rather than causal, so it should also be interpreted in that way. So here, really to conclude, our framework provides that real-time signal of non-oil growth, which allows us to improve that accuracy around different turning points. We're trying to really enhance that transparency around machine learning through the utilization of these shapely values. And we're really trying to offer also a direct application for IMF surveillance. So really our GCC country teams, which at the time when we had worked on this, I was also there. So really, I really want to thank all of the participants here for kind of looking through that. And of course, also to Moez, Zouheir, Sami, Reem, and of course, my co-authors, Monica, Yevgenia, and Tongfang. And lastly, also a very big thank you to the government of Kuwait and the Kuwait Investment Authority for allowing us to utilize this platform and, present at the IMF-CEF Center. It's really been an honor for us to be a part of the launch of the IMF-CEF and the EMEA Joint Research Webinar series. So really thank you so much. And I will hand it over now to Zouheir to guide us through the question process. Thank you.
Thank you very much, Monica. Thank you, Greta, for the great presentation. I've been receiving lots of questions. I'm still actually going through them, so they're still coming in. But I did repackage some of them, and I think we have a few good questions. So some participants were asked sort of the same question, so maybe I'll start with that. So Dafine from Comoros and others, they were wondering whether your methodology can be adaptable to other contexts, meaning other than resource-rich countries. So, for example, the Comoros is an economy that's heavily dependent on agriculture, fisheries, tourism, and remittances. So how can you say something about whether this is something they can do for rapid estimates of non-public sector GDP?
I can say a few words, then Greta, maybe you have more things to add. So in general, the short answer is yes. In one of the slides, we showed that we try to group the variables into different category, which is slightly different from how Greta shows in the presentation of the different sectors, but they are consistent in the sense that we capture both the commodity and the non-commodity sectors. So it really depends on what the data is available and how big the size of the commodity. Sorry, if the focus of the nowcasting is also on the non-commodity sector of the GDP, and there is just still a direct indirect link between the commodity sector versus the non-commodity sector, this framework can be also useful for the country. And Greta, please, yeah.
Yeah, absolutely. So I think it's important to emphasize here that our framework is completely adaptable. So you can adapt it to any country and also any subset, right? So if you wanted to look at CPI or, as we mentioned, the services GDP specifically, but again, that data footprint would change, as Monica mentioned. So you have to then apply all of those subsets of data to Comoros, and you have to find the right set of high frequency indicators, which could necessarily be a little bit of a challenge, because if you are data constrained, then you have to look at different sources of data, which is something that we didn't necessarily need to explore. But when you're thinking about maybe a smaller economy or something that's a little bit different, you have things like nightlight data, Google Trends data, Waze data. All of these are going to be more of a non-traditional data source that you could add in and kind of enhance some of those data gaps that you would have. But really, the value is greater where you have a little bit more data. But again, bringing in some of those external indicators would be beneficial. And the beauty of machine learning is that sometimes the indicators that actually work well with your framework are not necessarily super intuitive, because you're capturing again some of those non-linear relationships. So our whole process of starting with, millions of series and narrowing it down, you would essentially have to do the same thing for your country or, your subset of data. And you would be able to find some, but it would just take a little bit longer if the data is not necessarily available, but 100% totally doable.
Wonderful. Thank you very much. So Reem is asking our co-panelists, how does the focus on non-oil activities change the policy signal compared to headline GDP, particularly in periods of oil price volatility? And do you think that your work speaks to the critiques of the need of moving beyond GDP?
Thanks a lot. I saw the Reem's question in the chat earlier, and I think the second part of the question, what she meant is the need to move beyond the oil GDP, right? Specifically. Okay, so the short answer is that what we are trying to do here is not to replace the official GDP. And official GDP always give us more information, especially on the demand side. So what we are here now casting is on the supply side. If we were map 1-to-1, let's say like look at the non-oil GDP on the supply side, some of them will come from the consumption, some of them come from the investment, some associated with the trade balance. So what is really more informative for to calibrate a policy decision and policy advice is really looking at what are the drivers of those growth. So for example, when we look at if the non-oil GDP growth is supported by the more robust investment and consumption domestically and also external demand, instead of purely driven by the oil exporting or like a production associated with the oil sector activities, that kind of sends a signal of a more robust, the more healthy growth of the economy and the progressing of the reform. But this is something that we cannot really replace the official data, because only the official data has the decomposition from the demand side, and we're trying to nowcast for the supply side. However, maybe for the country like Saudi Arabia, with the flash estimates published only 30 days after reference day, our value added tend to be a little bit small compared to other countries that takes a longer to publish, that we can have a little bit of the signal of where the direction of the economy would be. then come into the interpretation with the Shipley value. That also gives us a signal and a foundation of what can be the underlying factors. As in one of the slides that Greta showed you before for the Saudi Arabia, in the most recent data, the most recent result, the growth, we have seen more higher marginal contribution from the non-oil exports and from the manufacturing proxied by the salmon delivery, but negative marginal contribution from the oil prices. So that's a signal tells you that it's going towards the right track that we're expecting the reform as a progress. Instead of saying that if it's the opposite, that say most of the growth are coming from the marginal contribution of the oil prices, which is purely driven by the external conditions, then that should be sending a signal that we need to revisit if our policy advice is still valid or needs to be tailored differently. Hope that answers your question, Rain. Thank you.
May I
And
kind
Greta,
of, yeah, absolutely. I just wanted to highlight just 3 additional points to what Monica was saying. Really what we're just trying to do is we're separating those domestic conditions from some of that oil-driven volatility, which is really kind of visible in that headline GDP, because we see those oil price swings really kind of can dominate it sometimes and really have a lot of movement there. So it just allows us to really separate that. And when you're talking about that signal and whether it's more policy relevant, well, this actually allows us to look a little bit more on the fiscal, labor, and structural policy side, because that signal speaks more directly to this. So it's actually helping us to see something that's a little bit different without abandoning GDP. And when you're talking about that beyond GDP, as Monica was saying, we're not actually trying to discard or replace that GDP. We're just trying to decompose it to extract more information from those different components using some of that high frequency data to make it a little bit timelier and more actionable, especially actually during those periods of oil price volatility that would actually drive that headline GDP in a different direction. So just trying to do a little bit more with the data that is given to us. Thank you.
Thank you very much, Monica and Greta. I have a couple of, I've seen a couple of technical questions. Since this is actually kind of a technical paper, I thought I'll give them to you. I guess these must be like short answer questions. So I have Hanan and Ziad from Tunisia. They're asking whether your variables are rendered stationary first. How does your methodology handle missing data points? And your interpolation, is that quadratic or cubic spline? And finally, do you compare the performance of the models to with a factor augmented vector autoregression model?
I think I answered some of the questions in the chart, but maybe
Okay.
maybe I missed some of them.
That's fine.
Let me go on by
Yeah.
one. I can surely answer. I remember the non-stationary question. So for machine learning, we do not require the variable to be do not assume the stationality as what we typically see in the time series model, like a RIMA. Usually the variable needs to be transformed to or demeaned to become the non-stationary to fit into the time series model. But for machine learning model, is a completely different, because we wanted the raw data to give us the big picture of the whole story. So that was the first one that you were asking, right? And sorry, try to break it down to different
missing data points.
The missing data point showed it in one of our previous slides that we typically, well, Greta can add more details, but in general, we consider the variable with the coverage of a minimum 10 years, with some of the exception that the variable with the shortened spanning sample period, but really gives us a good and a robust result. But 10 years is kind of the minimum that we are looking at. That gives us a sufficient a sample to look at both the in-sample and the out-of-sample performance.
And then there's a question about whether you compare the nowcast performance of the machine learning models with a factor augmented vector autoregression model.
I don't recall we have the augmented factor, the model in our comparison, but Greta, you can, please feel free to add.
So we don't have that one, but we do compare to other kind of more strong parametric assumptions and approaches. So we also compare to like VARs, OLS, and things like that we didn't include in the presentation, just because we wanted to see how our approach kind of trades structure for flexibility. So we do find that some of those more balanced panels are harder to scale with so many high frequency indicators, whereas our framework is a little bit better suited for some of those large unbalanced data sets with that short-term real-time monitoring. I think you had also asked about missing data points and how we're handling that. So we've actually experimented with different ways at handling that. We try to first rely on model-specific handling. So some of those tree-based methods, they have a natural robustness within them to assess those gaps and kind of carefully align the sample better rather than us doing an aggressive interpolation that then our nowcast would reflect that information. But we do have some series in very specific cases, and Bahrain is really the one that comes to mind, where we find some of those series to be very, very important for those short-term signals, so those POS transactions and so on, where we don't necessarily have that full 10-year span of data. And so in that case, then we are kind of backcasting a little bit to do that. But in that case, we're using a simple interpolation, not, I think you had said cubic spline.
Yeah, cubic spline or
Okay,
quadratic.
yeah. So missing
Yeah.
observations that we have that are backcasted, that is very rare, but if we do it, we're using linear or low order kind of quadratic interpolations. We're not doing cubic splines because cubic splines are more inclined to be to do overfitting, and they actually have more of an artificial smoothness that we're not necessarily trying to do. And this is for us kind of driven by more of like a real-time credibility, not fit situation. Also, if you recall, I'm a mathematician, so for me, this is, very intense stuff to look at. But again, our interpolation really plays a limited kind of supportive role. We're not trying to do that so much. Thank you.
Thank you very much. I mean, close to that, Hagar was wondering whether you tried to compare your machine learning methodology with more traditional, maybe nowcasting. I think you did mention something about that. Simple nowcasting models such as bridge and stuff, and whether you can say how your estimates compare to that, and also whether you tried maybe to combine some of these things together.
Monica, would you like to start or should I go ahead?
Please go ahead. I didn't quite get the question.
Yeah,
Okay,
sure.
so do you want me to repeat it?
No, we can go ahead. No worries.
Okay.
Yeah, so simple nowcasting models, they're a useful benchmark for us, but they're more restrictive. So when you're thinking about like a traditional approach, like a bridge equation or like a smaller DFN, this really relies on a more limited set of indicators, and it's a more of a linear relationship, which can miss some of those nonlinear dynamics that we're trying to capture in our high frequency data. So we're not necessarily comparing it to those, but we do have a really large set of those 20 to 30 models that include then some of our more traditional ones like the OLS, like VARs and things like that, just to see how we're comparing to something a little bit more traditional. And our framework really generalizes all of these models. It doesn't necessarily discard them. So we're picking the best model, but we have all of the estimates for every single one of the models. So this way we're able to see also across, say, the 20, 30 models, how does our estimate compare, and actually do, say, for example, a simple box plot of all of those estimates and see, okay, where are we looking at our median, where are we looking at our mean, just to see across all the models what are some of the big differences. And also, many simple models are really nested within our approaches of different machine learning models. So regularized linear models often perform like better in some of these stable environments, whereas again, those machine learning models add that flexibility. And really our main gain here is just the robustness around those shocks and those turning points, my assumption would be that if we didn't have, some of those larger oil price shocks like earlier on in 2014 and some of that COVID dynamic, then maybe some of those more traditional ones would perform a little bit better. But in this case, since we've had some of those larger shocks, then that's why we're leaning towards more of those like larger, more complex, let's say, machine learning framework. But again, it's really important to note that our framework, again, is model agnostic. So every time we run it, we are able actually to select a different model. So we're not necessarily like married to one type of model or even, one model at all. So we're able to actually see, okay, maybe during this period, we'll see a better progression using our random forest model. So we're actually able to drive to that. So that's one of the really advantages, because we see all of the different models and we can compare and contrast and really kind of adjust along the way.
Wonderful.
Thanks a lot, Greta. I just to add one more point. So during our
Okay.
past 2 years of the testing, we see that the top 3 models for each country, they produce very robust result in terms of the very similar level of the out of sample rooming square error. And in our, because I'm from the Saudi Arabia desk, so I want to highlight that because we are looking at the non-oil private activity to have a fair comparison with authorities' data. But when we actually in our desk project the non-oil GDP, which is the sum of the non-oil private activity, the government activity, the net taxes. We use the bottom-up approach. So the nowcast help us to really refine our macro framework for the non-oil private activity, the non-oil activity component. Then for your government activity, it works better with the traditional time series model like AREMA, because it has much stronger seasonality pattern despite the oil shocks. So that's the time that like traditional model comes in, tend to be better and also more efficient to help us to have this bottom-up projection for the non-oil GDP. But for the non-oil private activity, it's just due to its difficulties and the link with too many things and the interlinkages across sector. So that's why we that's how we started. That's why we started with our work on this nowcasting.
That's very clear. Thank you very much. We're a bit 2 minutes over time, so I think I'll finish the Q&A session here. I'll give the final word to Moez for the closing remarks. Thank you very much, Greta and Monica.
Thank you.
Thank you very much, Zouheir. Thank you all for being part of this new initiative. I would like to thank sincerely Greta and Monica for the excellent presentation and their insights on how to nowcast non-oil GDP in resource-rich countries. I would like also to thank Reem and the EMEA for this impactful collaboration, and Zouheir El-Sahli for organizing and moderating the event. I would like also to thank Nizar for the IT support, which made this event happen. I would like, as usual, to extend our special thanks to the State of Kuwait and the Kuwait Investment Authority for hosting and providing vital support to the CEF. Kindly note that the recording and presentation will be posted on our website, cef.imf.org shortly. And you can also consult our website for future CEF training, seminars, and conferences. On behalf of the IMF-CEF, thank you, and we look forward to welcome you again soon. Thank you very much.
Thank you all very much. Have a nice rest of your day.
Thank you all.
Thanks everyone.
Thank
Thanks
you.
to our audience. Thanks to Reem. Thanks to everyone. See you soon. Bye.